Let me paint you a picture. You wake up Monday morning. You go to work. You put in your 8, 9, maybe 10 hours. You come home tired. You check your bank account before bed, just like you always do, and you notice something. Your paycheck came in. It always does. You're responsible. You show up. You do everything right. But somehow the number in that account looks almost identical to what it looked like 6 months ago. A year ago. You're not buying luxury stuff. You're not going on crazy vacations. You're just living. Groceries, gas, rent, or mortgage. Maybe dinner out once a week because you deserve it. And yet it feels like you're running on a treadmill that someone secretly turned up the speed on while you were sleeping. If that hits close to home, stay with me. Because what I'm about to show you is not about you being bad with money. It's about a system that has quietly and mathematically been shifting wealth away from people exactly like you. And the weapon being used? Interest rates. My name is Dean, and I spend way too much time thinking about how interest rates affect the everyday financial lives of ordinary working people. If you're someone who feels like you're doing everything right but still not getting ahead, like the rules of the game keep changing and nobody told you, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. All right, let's get into it. Here's the thing. When most people hear interest rates, their eyes glaze over. It sounds like something economists argue about on cable news while you're trying to figure out how to pay rent. But interest rates are not background noise. They're the single most powerful force shaping your financial life right now, whether you understand them or not. And the less you understand them, the more expensive that ignorance becomes. Literally, simple version, an interest rate is the cost of money. When you borrow for a house, a car, or a credit card, you pay interest. That interest is the price tag on the money itself. When rates go up, that price tag goes up on everything. The Federal Reserve controls something called the federal funds rate. This one number influences the interest rate on your mortgage, your car loan, your credit card, your student debt, every single one. So when the Fed raised rates from near zero to over 5% in roughly 18 months, the fastest hiking cycle in 40 years, it didn't just make headlines. It made your financial life measurably harder. And the middle class got hit first and hardest. In January 2021, the average 30-year mortgage rate was around 2.7%. Let's say you were buying a $400,000 home, putting 20% down, financing $320,000. At 2.7%, your monthly payment, roughly $1,300. By 2023 and 2024, rates climbed past 7.5%. Same house, same loan. At 7.5%, your monthly payment jumps to $2,237. That is nearly $1,000 more every single month. For 30 years, on the exact same house. The house didn't get better. The neighborhood didn't improve. The only thing that changed was the cost of the money used to buy it. And over the life of that loan, you'd pay over $485,000 in interest alone. More in interest than the original price of the house. Here's what most people don't realize about that $937 monthly difference. That's the difference between contributing to your retirement or not. Between handling a $2,000 emergency or putting it on a credit card. Between financial breathing room and financial suffocation. Wages didn't go up $937 a month. They didn't come close. The Federal Reserve Bank of Atlanta showed that at the peak of this rate environment, the share of income needed to buy a median-priced home hit levels not seen since the early 1980s. People who bought in 2020 locked in generational rates. People trying to buy today are locked out entirely. Now you might be thinking, okay, Dean, I'm not buying a house right now. Maybe this doesn't apply to me. Oh, it applies. Americans are carrying over $1 trillion in credit card debt right now. That's a record. And the average credit card interest rate has climbed above 20%. Some store cards are running at 27, even 29%. Let me show you what that actually costs. Say you have $5,000 in credit card debt, which is below the average American household balance. At 20% interest, making minimum payments of around $100 a month, here's what happens. It takes over 8 years to pay off, and you pay roughly $4,300 in interest. on $5,000 of original debt. You pay back nearly double. And here's the psychological piece that makes this devastating. The minimum payment system is not designed to help you pay off debt. It's designed to keep the monthly number small enough that it doesn't feel urgent enough to change. The payment feels manageable, so you keep paying it, and the bank keeps earning. And you keep working, showing up every day, while a portion of every paycheck quietly gets transferred to a bank's balance sheet before you ever get to build anything with it. I know what some of you are thinking, but Dean, higher rates are good for savers. I'm finally getting 4 or 5% on my savings account. And technically that's true, but here's the thing. Who actually benefits from higher savings rates? People who have significant savings sitting in cash. And who in America has significant savings sitting in cash? Not the family carrying $5,000 in credit card debt at 22% interest, earning 4.5% on your $2,000 emergency fund, while paying 22% on your credit card is not a win. That is financial quicksand dressed up to look like solid ground. Federal Reserve research consistently shows that the top 10% of Americans own approximately 93% of all stocks and hold substantially larger cash positions. When rates rise and savings accounts pay more, the wealthy benefit. When rates rise and borrowing costs explode, the middle class bears the cost. High interest rates are, by their very nature, a wealth transfer mechanism, and the transfer goes in one direction. All right, we've diagnosed the problem. Now let's talk about what you actually do, because I'm not interested in leaving you informed and hopeless. First, attack high interest debt with everything you have. Paying off a credit card at 22% is the equivalent of earning a guaranteed 22% return. No investment offers that. Use the avalanche method. List your debts from highest interest rate to lowest, throw every extra dollar at the top one while paying minimums on the rest, and roll that payment down the list. The difference in total interest paid compared to minimum payments is dramatic. We're talking years off your timeline and thousands of dollars saved. Second, know exactly what rate you're paying on everything. Variable rate loans, home equity lines, adjustable rate mortgages. Adjust with the market. In a rising rate environment, they get quietly more expensive without you noticing until you look closely. Pull up every debt you have this week. Know your numbers. Third, build the emergency fund that keeps you off credit cards. Most high-interest credit card debt starts with an emergency. The car breaks down. The medical bill arrives. Without cash reserves, a credit card is the only option. 3 to 6 months of expenses in a high-yield savings account. Yes, take advantage of those rates while they're available. Is the financial immune system that keeps a $2,000 problem from becoming a $4,000 problem a year later. Fourth, keep investing consistently regardless of the environment. Here's what most people don't realize. Historically, the period after a rate hiking cycle ends has been one of the strongest for stock market returns. The people who kept investing through the painful part captured the gains when sentiment shifted. Time in the market beats time in the market. Every single time. Look, the system is not going to explain itself to you. The credit card company is not going to call and say, "Hey, we feel bad about that $4,000 in interest you're paying." That call is not coming. But you can educate yourself. You can understand the forces at work. And you can make one decision this week, just one, that moves you in the right direction. Pay an extra $50 toward your highest interest debt. Open that high-yield savings account. Pull up your rates and actually look at them. Knowledge without action is just trivia. But action without knowledge is just expensive guessing. You now have the knowledge. The action is on you. If this video gave you even one thing you didn't have before, hit the like button. Subscribe if you want to keep going deep on this stuff. Real numbers, real math, real strategies for real people. The world rewards those who understand it. See you in the next one.